Hello and welcome back to another video on how to secure yourself financially. So right now what I'm looking here as is it is the beginner guide to financial statement. Okay, and after all, the SEC mentioned that if you're able to read nutritional labels or soccer box score or baseball box score, you can learn to read the basic financial statement. And if you can follow a recipe or apply to a loan, you can learn the basic of accounting. And the basic, they're not difficult. So this section will give us basic understanding, especially when we need to see a set of financial statement and to make sense of them, right? So after all, the financial statement show you the money. Period. From the Cuba Goody Junior Immortal Lines in Jerry Maguire, show me the money. That's what the financial statement does. And you have four types of them. The balance sheet that show what a company owns and what it owes at a fixed point in time. Income statement, how much money a company may and spend, again, over a period of time. Cash flow, the exchange of cash between the company and the outside world, as well as the statement of the shareholders that show the change in interest over time. So first, or in this section, they just focus on these three first statement. The balance sheet, the TLDR, is that it shows you the company assets, liabilities, and shareholders' equity over a period of time, whether it's annually, quarterly, you name it. Income statements, the bottom line of this tells you if a company made a profit or not. And the cash flow report the inflow and outflow of cash of a company. And this is important because company needs to know and have on hand cash to pay its expense or to purchase assets. So while the income statement can tell you whether the company, in this case, the net income from income statement can tell you whether a company made a profit, the cash flow can tell you whether a company generate cash over a period of time. And it reuse some information from the balance sheets and the income statement. Okay, and then the bottom line of this statement show you the net increase and decrease of cash, and it is made of three parts where each one of these parts review the cash flow from the three main type of business activity. So according to Investopedia, you have is operating, financing, and investing activity. So the operating assets or the operating activities, what it does is to look at the net income, okay, from the income statement and conciliate with the total cash that was used or perceived from operating assets. And to do that, well, it just adjusts the net income from the income statement to any non-cash items, meaning items that affect the income or the balance or that affect the income statement. Okay, this is our items that affect the income statement, and there are no cash involved. So here we have the for example, stock-based options, as well as the stock-based options, And amortization and compensation. Yeah, amortization and compensation, or amortization or depreciation. This is just example of non-cash items, and also it adjusts the total cash that was used or perceived from other operating assets, right? And to understand this, actually to understand what are the other operating assets or what are the operating uh, activities, it can lay out in two branch: the operating assets and liabilities, and the most common case of each one of them. So on operating assets we have is the inventory, prepay expense, which are expense that the company pay in advance for certain good and service to enjoy, such as premium insurance like health for medical coverage, home or vehicle to protect them in the case of thief or damage or any potential catastrophe. Life in the event of the policyholder maker, in the event of the policyholder death. Liabilities such as lawsuits, disability, and long-term care, such as nurse home care or home health care. Another example here on the prepay expense are rent, marketing, software licensing, eh, office supplies, contract or maintenance contract. Keep looking at the other operating assets we have is the accounts receivable, in intangible assets such as patent, exclusive right to provide or exclusive right to the original inventors to manufacture and distribute their invention over a period of time, such as maglev, issued in 1979, which is this electromagnetic stabilization and suspension system for ground vehicle. GPS, this navigation system with satellites and passive ranging technique, issued in 1974. The electronic device, or aka the iPhone, in 2007. The CRISP, or this gene editing, in 2014. And then I look at the trademark: image, audio, designs that uniquely identify this company from the rest. For example, Michael Burry and his famous quote, "Let's get ready to rumble." Copyright, exclusive rights to creator of original work to distribute and manufacture, as well as sell their invention over a period of time, such as Netflix, Spotify, McDonald's. Trade secrets, which are exclusive, are confidential data that company may take advantage from others to gain competitive advantage, such as process, formulas, or customer lists. Goodwill, the company reputations, recognitions, and customer loyalty. Uh, as well as customer relationship. This is just example of intangible assets. Keep looking to another operating assets. The most common are investment in affiliates, which is a company that invests in another company to earn uh, influence but not full control, with the idea of earn a return on the investment or a competitive advantage, or even both. Joint ventures, a partnership between two or more companies to undertake a specific business activity or project, such as uh, Crocs and Post Malone. Equity investment, which is the vast majority of investment in affiliate examples, where now a company purchase significant amount of stake in another company's stocks to gain influence and potentially raise a voice on the another company management decision. For example, here is this is also known as the venture capitalist, venture capitalist or VC, venture capitalist or equity investment. Example of this, you have Berkshire Hathaway, led by Warren Buffett, which is a multinational conglomerate holding company. And by holding company is a company that instead of engage with another company through any other business operation, it does that through owning stocks. So Berkshire Hathaway, for example, invests in a variety of companies uh, in different industries like energy, real estate, and retail. SoftBank is a Japanese conglomerate that invests primarily in technology companies like WeWork, Uber, Airbnb. You also have is Alphabet, the parent company of Google, that again invests in a variety of primarily technology company. Calico is one of them, which is focused on health and longevity, as well as the mm, yeah, as well as the what is the other? What is next? Keep looking at the investment in affiliate examples. TPG, which is a private equity firm that invests again in a variety of sectors: real estate, healthcare, uh, and retail, as well as Blackstone. Again, global investment firms that invest in a variety of sectors, as well as real estate. And most of them invest in real estate. It's like, interesting. Interesting. So, in any case, then I look at limited partnership in investment in affiliate, where now a company, as an investor, purchased stocks to gain control over the assets partnership, or over the partnership assets and operations. Okay, so yeah, this is kind of like the another another variant of VC, venture capitalist, which is great, cool. Uh, and then I also look at associate. which are investors that owns a considerably amount of stocks in that company, typically between 20 and 50%. In looking at other operating assets, the most common, well, what you have is a cash and cash equivalents, like money market funds, where this is our funds that invest in a very short-term debt instrument uh, to uh, later on sell that, such as bank deposit, which is a bank issue a saving certificate with a short-term maturity, banks debt, commercial papers, which are risky companies, yeah, which are risky, uh, um, yeah, which are risky commercial papers, or commercial papers are risky company debt, and the repo, the repurchase agreement, debt issued by the government primarily, right? So once I look at all of this, or the most common operating assets, then I look at the most common operating liabilities, such as accounts payable, money that you own to the vendors or suppliers, uh, such as raw materials, office supplies, service, and this is usually a short-term debt, 30 to 60 day. Accrue expense, however, is different because now these are expenses that a company incur in advance uh, for good and service that has been rendered to them but has not yet paid for, such as wage and salary, utilities, rent, taxes. Okay, and so yeah, and I also look at deferred revenue, which are payment that you collect for future obligations to deliver a good and service, such as subscription service, gift cards, uh, and contract maintenance contract. Okay, that's great. That's great. So keep looking now another operating liabilities. Okay. Mm-mm-mm. We have is operating. That's right. Keep looking at another operating liabilities. Okay, so we have is the income tax payable and short-term borrowings. Okay, income tax payable. I think this is a rabbit hole that I'm gonna enter here. This is definitely a rabbit hole that I'm gonna get into. Okay, you have income tax payable. It never generate the answer here. Income taxes payable refers to the amount of income tax. Okay, so income tax payable refers to the amount of income tax that a company owns to the government for a specific period. Okay, so income tax payable is the amount of money that a company owns to the government for a specific period. Okay, so what are the subtle difference between the accounts payable is that money that you own to your supply and vendors, accrue expense that you incur uh, for good and service that has been delivered but not yet paid for. Okay, deferred revenue is that payment you collect for future obligations to provide good and service. And income tax payable is money that a company owns to a government for a specific period. Interesting. Okay. So it represents a liability on the company's balance sheets, as the company has an obligation to pay its income taxes to the government. Yeah, as the company has an obligation to pay its income taxes to the government. Income taxes payable are usually short-term liabilities that are expected to be paid within a specific period, such as the end of the fiscal year. Okay, and they when they mean short terms, usually in the finance sphere, means like a year or less. The amount owed is calculated based on the company taxable income and the applicable tax rate. Example of income taxes payable may include corporate income tax, withholding taxes, sale taxes. Okay. Corporate income tax. If a company generates taxable income, it's required to pay corporate income to the government. The amount owed is based on the company net income and the applicable tax rate. Withhold taxes. If a company has employees, if it is required to withhold taxes from their salaries and remit the amount to the government on their behalf, the amount withheld is based on the employee taxable income. That's some. I remember something that talking about taxes. Oh my God! I need to pay my taxes. Holy shit! Holy crap! I need to pay the taxes, man. Okay, pay taxes. Okay, look email. All right, look accountant email. Okay. Okay. Jesus, yes. Okay, you have corporate income tax, withholding taxes, sale tax. Managing income taxes payable is important for maintaining compliance with the tax law and regulation, as well as for managing the company cash flow and financial position. Timely payment of income taxes helps to avoid penalty and interest charge, and can also help maintain good relationship with the government authority. Uh, but yeah, so this is income taxes payable. Okay, it's money that you owe to the government for a short period of time, and when they mean short term, a year or less. Okay, so example of the income tax payable may include corporate income taxes, corporate income tax, meaning here we go, withholding taxes. Corporate income tax is tax levied on the profit earned by corporation or business. Tax The tax is typically based on the taxable income that a company earned during a given fiscal year. Corporate income tax rates vary depending on the country and jurisdiction in which the company operates. In the United States, for example, the federal corporate income tax rate is a flat rate of 21% on taxable income. To determine the amount of corporate income tax owed, a company must first calculate its taxable income, which is generally it is revenue minus allowance. Okay, allowable deduction, I mean, an exception. Deductions may include business expense such as salary, rent, and depreciation, while exception may include tax credit for research and development or capital investment. Mm. Deduction may include business expense such as salary, rent, and depreciation, while exceptions may include tax credit for research and development or capital investment. Companies are generally required to file annual tax return and pay any tax owed to the government by a specific due date. Failure to pay the requirement corporate income tax can result in penalty and interest charge and can have negative implications for a company's financial position and reputation. Managing corporate income tax is an important aspect of the business operations and financial management. Company may work with tax advisors and accountants to help minimize the tax liability and ensure compliance with the tax. So, in other words, corporate income tax uh, is a tax on the profit earned by corporation or business. And the United States is a flat rate of 21% taxable income. Okay, income income tax or corp, corporate income taxes. Corporate income tax rates. Exactly, by PwC, corporate income taxes rate. hmm Holy shit. Interesting. Okay. Mm. Do you have any map for that? Where I can offer this? Map view. That's right. Oof. The burden in South America is fucking heavy. Mm, Europe, North Asia, Australia, Middle East, 20%. Saudi Arabia, Oman. There's no data here. Pakistan. Interesting. Okay. South America. Jesus. 34, 34, 35, 29, 22, 28, 35, 25, 27. Jesus. 25. Paraguay. 10%. Hmm. Guyana. The only problem with Paraguay, setting up Paraguay is like you're not going. Man, Paraguay is connected to the international world. That's the question. It's like, really? Oh my God, what I'm doing here is it's like seeing the Matrix. Uh, Holy crap! You can have a company in North America and then invest in another in South American company. Jesus, fucking Christ. Beware with this nigga. In Europe, 19%, 21%. Spain, 21%, 25, 24. Bosnia. Okay, but this is the Balkan. Serbia, Hungary. What about Slovak Republic? Such as Republic. Mm, Lithuania, Ukraine, Romania. Romania. What? I know, but this is Moldova. Romania, 60%. Oh my God, that's the reason why they go to Romania, man. Georgia, 50%, 20% for banks, credit union, microfinance organization, and loan providers. Georgia or Romania? Moldova and Romania. Uh, does Romania belongs to Europe or Georgia? Georgia belongs to Oh my God! To me, it's funny because like what? It's like you're looking now. You're looking now, man. It's like Moldova, Romania, and Poland, Lithuania. Formally applied for European membership. Oh, holy shit! This is fairly recent. Oh my God! Georgia formally applied for European membership. But this is the last year. Both Georgia and Ukraine are former Soviet states that fears a renewed takeover by Russia. Oh, okay. Exactly, but they formally apply, but there's no news in there. It's like, man, you have to comply. You have to comply. Okay, that's one of the reasons why doing business here is like, damn, son. Damn, son. That's sad. You know what I mean? It's like, that's very, very sad, man. That's very, very sad. Income from real estate. They know that the real estate is the business. There was another reason why a lot of people, here, they have this. What? Sri Lanka. Domestic companies, foreign companies. Mm. This is a very interesting map, by the way. All right, all right. Okay. Okay, so this is something interesting. Corporate income taxes rate. Holy fudge. Corporate income taxes rate. Corporate income taxes rate. Mhm. Corporate income taxes rates. Exactly. So corporate income taxes rate. Mhm. Mhm. Come on, man. Interesting. Corporate income taxes. Okay. But in other words, so corporate income taxes are a tax that is charged on the profit. It is a tax on the profits earned by corporations. So in the United States, there is a flat rate of 21% on taxable income. Then you have withholding tax, meaning. So withholding tax refers to the amount of tax that is withheld from an employer's wage or salary by the employers and paid directly to the government. Withholding taxes. The purpose of withholding taxes is to ensure that the government receive a portion of an individual income throughout the year, rather than having to wait until the end of the year to collect the full amount owed. The amount of withholding taxes that are withheld from an employee paycheck is based on their taxable income, as well as their tax filing status and number dependent. The employer is responsible for calculating the amount of withholding taxes owed and deducting that amount from the employee's gross pay. Withholding taxes are typically applied to a various type of incomes, including wage, salaries, bonus, and tips. The amount of withholding taxes owed can also vary depending on the specific law and regulations of a given jurisdiction. Managing withholding tax is an important aspect of the payroll and tax compliance for employers. Employers must ensure that they are properly withholding the correct amount of taxes from their employee paychecks and must also file accurate tax return and remit any tax owed to the government in a timely manner. So in any case, This is withholding taxes and sales tax. If a company sells goods and services that are subject to sales taxes, it is required to collect the. So corporate taxes are taxed based on the company profits. And the United States is 21%, is a flat rate of 21%. The withholding taxes, if a company has employers, it required to withholding taxes from their salary and remit the amount of the government. And then you have sale tax. If a company sells goods or services that are subject to sale taxes, it is required to collect the tax from its from its customer and remit the amount to the government. The amount collected is based on the sales price and the applicable tax rate. Managing income taxes payable is important for maintaining compliance with tax. Exactly. So that'll be all for this video. Take care. Bye bye.